On the podcast with us today is Darin Batchelder. Darin, welcome to the podcast.
Thanks, Dan. I appreciate you having me on.
Well, I'm looking forward to diving into this property, this Hampton Townhomes, which is going to be located in, actually, I didn't even talk about where it's located. So where is this located?
It's actually located in Crowley, Texas, which is about 15, 20 minutes south of Fort Worth.
Awesome. So, and it's going to be, it's a 76 unit property, and you closed on this one in December 2018. So just last year.
That's correct. So just about 5 months ago.
Awesome. Well, I like talking about properties that just closed because it's usually fresh in our minds, and maybe even talk about some things that you've done since the December closing and some of the process there and the takeover from property management. But before we dive into that, I want you to talk to the listeners a little bit about you and your background and how as it relates to this multifamily space.
Absolutely. Thanks, Dan. Yeah, so I've got pretty diverse background. I started out as a CPA with Price Waterhouse. I then transitioned to internal audit within PepsiCo, worked both domestic and international audit for PepsiCo, and then wanted to get out of the accounting space and transitioned into the ERP software sales, so selling large ERP software systems to the Fortune 1000. And at the end of that stint, went and did the .com thing, worked for a credit company called eCredit.com, and then as the .com bubble kind of burst, I transitioned over to a completely new industry, and where I got hired by ABN AMRO, which is, I don't know if you're familiar with them, but at the time they were a top 20 worldwide bank. Don't have much of a retail presence in the U.S., but they're very big in the capital markets. So they're very big in Boston, New York, Chicago. And I was in Boca Raton, Florida, and I was on their mortgage capital markets trading desk. And our role was they were originating billions and billions of A prime residential jumbo paper, and they didn't want to keep that on their balance sheet. So they were selling that to Wall Street, and then they created this capital markets group that I became a part of, and our job was to resell those loans directly to other banks across the country at better margins than if we just sold it to Wall Street to go into securities. One of the interesting things that happened while I was there, and I was there during the kind of 2002 to 2006 timeframe, which was the big run up in real estate. And while I was there, they went and purchased a bank out of Chicago called LaSalle Commercial Bank. And LaSalle had a large multifamily portfolio. So in addition to selling large residential portfolios, we started to sell large multifamily portfolios direct to other banks across the country. So I became very familiar with the asset class from the standpoint of selling larger portfolios. Then in 2006, as the market kind of started to turn, I left the bank. I banked a lot of money, did very well during that run up, and took like 6 months off and got my handicap down, and wasn't really sure what I was going to do. I always told my wife that, hey, when this ends, then I want to start my own business, but I wasn't sure what business I was going to start. So over that 6 months, I was kind of trying to figure out what I wanted to do. And I just happened to call some of my banking relationships and said, hey, if I was to start a one-man shop brokering loans, would you do business with me? And, part of my mindset was these guys aren't going to want to work with me because I'm not under the big bank umbrella. But that wasn't the case. So I was very thankful that I took the chance to make the phone call. And they basically said, hey, Darin, if you could find me quality loans, I do business with you all day long. You're not my counterparty. You're the broker in the transaction. All the due diligence would be with the other bank selling. So in 2007, I started my own company, TZK Capital, which trades loan portfolios between banks, and we receive a broker fee for doing that. And we've worked with large national institutions, regionals, small community banks, selling residential, multifamily, as well as commercial real estate loans. So how I ended up getting into the multifamily space was I always wanted to get into real estate, but I never had the desire to do single family. my business had gotten to the point where it almost I developed into kind of a recurring revenue stream, and which offered me some freedom of my time. And so I was itching to find the next thing to put my energy towards. And I finally decided in the fall of, fall of 2017, so about a year and a half ago, I'm going to buy something. So I went out and bought a new construction duplex October of 2017. And it was kind of a good and a bad. The good was it finally got me off the hump of actually buying something. The bad was once I signed the contract, I knew that I wasn't going to make a ton of money, and this wasn't going to scale. So I had to go bigger. So that's when I went searching for a way to go bigger, and I found a mentorship group in the Dallas area, and got involved with that, and it changed my mindset from, hey, I kind of thought I had to go duplex, fourplex, eightplex, 12plex, and it just seemed like it was going to take forever. But this group changed my mindset that no, you could go right into larger multifamily. So I joined that group December 2018, and just 2017, December 2017, and then in 2018, I invested in 7 passive deals where I invested my capital into other people's deals. One of them I was a key principal on. And then at the same time, I was chasing my first sponsorship deal and finally landed one near the end of the year. So it was a pretty crazy year. And, being around like-minded people and people that tell you can do it versus being around family, friends that have never done it, that will tell you you're crazy, is huge. So, I would, anybody that's listening to the podcast, I would advise you to, get on as many of these podcasts with Dan, get out to some of these meetups, meet other people that will tell you similar stories that they didn't know how to do it either. And other people will help show you the way.
Well, I want to dive into this property as well, because with it being as fresh as it is, we're going to get a lot of detail out of it. So why don't you get us started on this little 76 unit? I say little, it's not little. This is a big property. So this is this 76 unit property that you acquired, and then talk to us about how you found it first.
So interesting story on, it all comes down to stories. Interesting story on how we ended up getting this deal. My philosophy, again, it's kind of mindset. My philosophy, being kind of new in the sponsorship, was I didn't want to go out on property tours unless I had underwritten the deal and felt like it was a deal that I could put a letter of intent on. So I didn't want to waste the broker's time. Looking back on it, I have new people in the group that come to me and say, "Hey, Darin, it's been a year. What would you have done differently?" Well, what I would have done differently is I would have gotten out and done more property tours early so that I could have met more brokers, because if they don't know you, they don't know to call you on a deal. They don't know what you're looking for. They don't know that you're qualified. So the interesting part on this was I was actually bidding on a deal about a month prior in South Dallas. It was the same amount of units, 76 units. I went down, met the broker. It was a broker from Marcus & Millichap. Hadn't met him before. We just clicked. We got along very well. And, he spent a bunch of time with me, and I went after the deal hard. I was the lead bid within our group, but somebody outside the group paid like $300,000 more than I had bid. So I lost that deal. But during that process, I built the relationship with the rep at Marcus & Millichap. So he then pointed me to this deal. Okay, so he said, "Hey, I got this other deal in Crowley. Why don't you go take a look?" And so I did. I went and drove the property, and when I did, it was, so I live north of Frisco, in Prosper, and down to Crowley is about 15, 20 minutes south of Fort Worth. about an hour, 15-minute ride, and I didn't know that little sub-market that well. So I drove the property, and it wasn't that well maintained, and it just didn't give me the right feeling. I kind of left, and I called him back and said, I'm going to pass on the deal. So here's where it gets interesting, is that he calls me 3 days later and says, Darin, you have to meet me at the property. I have to show you the property. And so then I said, why? I said, you got to pitch me on why I should come back down there. And he just gave me kind of two big bullet points. One was, do you know what the household median income is in Crowley? And I said, I had no idea. And he said it was like 60,000. And that was very attractive because a lot of the deals that I had been bidding on in the DFW area up to that point were 30, 35,000 median household income. So that showed me that there was money in that little submarket. Secondly, he said, look, this is a 1980s property, individual AC, individual hot water heater, and they're townhome style, and they have larger ceilings. You have to come inside the units to feel it. So I said, okay, you've told me enough. I'm going to come down. And sure enough, when I got there, what he said was true. I walked in and I was like, wow, the interiors are very dated. But, if we were to rehab the interiors, I would much rather have a townhouse without somebody living above me and have higher ceilings than have an 8-foot ceiling and somebody living above me. So that was very attractive. So at that point, I said, I like the property. Now I just need to dig in and see, what I can do from a business plan, where I can take rents if I put, some rehab money into it and that sort of thing. So the moral to that story was, had I not developed a relationship with the broker on that prior deal, I would have just passed on this deal. I never would have gotten this first deal. So props to him.
How many other offers do you think, or do you know, were actually being presented to the broker and the seller at that time?
Yeah, on our property on Hampton, it was a very competitive deal. There was 10 or 12 offers and a ridiculous amount of people that they let into best and final. They had like seven or eight people in best and final, and we came out on top. Another thing that kind of helped there was, I don't know if you've seen this. You probably have seen this because you've done way more deals than I have. But I get the sense from looking at different brokers and what the whisper prices are. Some brokers like to have whisper prices that are such a stretch, and they try to push you so far, but nobody can get there. And other brokers have a different strategy where they kind of tease you with a whisper price that, wow, that's a good deal. That I could really make money on that deal. But then everything trades above the whisper because there's a lot of competition on it. So because I was on that prior deal with this broker, I kind of knew how he positioned the pricing. So I had already underwritten it to be substantially above where the whisper was. So I was prepared.
So how did you know, or how did you convince that broker that you could actually close this deal? Because this was your first deal that you had done on your own, wasn't it?
Absolutely. Yes, it was my first deal, but I didn't do it on my own. So I had help. One, within, so I'm within the Brad Sumrock group, and we have coaches. And so I've been working with, various coaches throughout the year and bidding on a bunch of properties. And so the coach on the deal has a relationship with the broker as well. And so the coach was basically saying, hey man, Darin's real. Like he's out there, he's doing all the right things. He's hustling, he's going to get one, this is a good deal for him. He's committed. Secondly, I know, kind of the gist of what happens once you get into best and final. It kind of gets narrowed down to 2 or 3, and the broker and the seller are going to have a conversation. The seller's going to say, who should I go with? And so, I had a mindset of I want to make sure I get picked. So how do I do that? I partner with a guy who has a lot of experience. So through all the marketing the different networking meetings that I went to all year, I developed relationships with a number of different people within the group that had mentioned, hey, if you get a good deal, I'd be interested in possibly working with you. So I reached out to one of those that my partner on this deal is Raj Gupta out of Chicago. And so I never would have met Raj. He lives in Chicago, but we're both part of this same multifamily group. We met a number of different times at different networking meetings, and we just got along very well. And so I told my coach I was looking to have him be my partner, and the coach said, you know what? Raj actually has a development deal outside of the group, a townhome development deal that he syndicated himself in the town next door to where you're buying. So we're in Crowley. The town next door is Burleson. It's a 100+ townhome development deal, and I didn't even know he had that. So when I called him on it, he said, I know the area well. And so the broker basically said, between your coach, giving us feedback, our relationship so far, and the seller really liked that your partner has local market knowledge and experience. All those things kind of tip the scales for us.
Mm-hmm. Now on this one, obviously you went through a couple of rounds of offers with 7 going into that best and final round. You ended up at a what was the final price that you ended up on as far as at the end of the rounds of offers?
It was $6,061,000, so just over $6 million.
Okay. And did you have to put up any earnest money deposit that went hard, like right away, or did you have was it 30 days? Did it go hard after the 30 days, or what was the process there with the EMD money?
Yeah. So in Dallas, it's pretty competitive, and that's another way to stand out. So one way is to have, the experienced team, the property management team, the attorneys all lined up, your financing, but also, they like the best price and they like a lot of hard money. So I was very committed to getting my first deal. So I offered, $150,000 hard on day one, which, is not chump change. And we ended up between contract, between having the deal awarded to us and contract negotiation, there was about 2 weeks. So that hard money goes hard once the contract is signed. Well, we had 2 weeks of negotiation. I happened to visit the property during that 2 weeks with my partner, and we kind of got the sense that the income might be dropping a bit. So during that 2 weeks, we renegotiated that hard money to be $75,000 hard day one, and then the other $75,000 when they hit a certain hurdle on income, because we wanted them committed because we didn't want our loan proceeds cut.
That's a smart way to do it. So, for those of you who might be new or might not know what hard money is, we're not talking about a hard money loan. It's not a hard money, lender he's going through or anything. He's actually taking money, $150,000 out of his pocket on the PSA assigned, which he's negotiated here down to $75,000, and saying, instead of waiting 30 days to do our due diligence, we're going to immediately, because we're confident with this property, this acquisition, with no contingencies other than usually title issues and environmentals, that we are saying this money is your money, and there's basically non-refundable, if you will. And so they call it going hard. That money goes hard day one. So that's great that you were able to negotiate that down in half, and then have that incentive or that extra kicker in there for that income level. That's great. I've seen it separated where, after 30 days due diligence, there'll be another, deposit for the earnest money. And then if you want an extension, there's another deposit on top of that for that earnest money. That was a smart way to kind of structure that way as well.
Yeah. I mean, it just all played out as as things played out. I mean, at first I just wanted to be very aggressive to win the deal. And then as we got in it, we just wanted to be, as smart as we could.
Yeah. Well, and I will tell you that a lot of markets are that way. So,
not just Dallas.
Yeah, it's not just Dallas. I mean, obviously for a $6 million, I think 150 is definitely a little bit on the high side for the hard money day one. It's not on the high side for
Total.
later on down the road for total, but
right.
yeah, I mean, even in some of the markets that we're in the Southeast and here in the Carolinas, we're seeing $100,000 to $500,000. And we actually just recently got outbid by a deal, and they were up by $200,000, and they did 1.2 million hard day one. So
wow.
Yeah.
Wow. It's tough to beat that, right? I mean, if you're a seller, it's hard to choose the other guy after that, right?
Come to find out, I was a billionaire out of Hawaii, so who knows?
Right.
But yeah, it's hard to compete with that. But at the end of the day, if you're confident with your group and you can close a deal, and it's not really, to me, that hard to do that, because it's going to be going towards the closing proceeds anyway. So it all kind of, as long as you can close that deal, everything washes out towards the end there. But there's definitely different thought processes behind, people who do and people who don't. Or I had some people say that they don't believe in it. I'm like, well, that's not really one of those things that you can believe in. It's either you do it or you don't. That kind of thing.
Exactly.
You either sometimes get the deal or you don't, based on, whether or not you put up hard money. So the next thing I wanted to ask you about here on this property is now that you've got the deal under contract, you're full on into the due diligence phase. During that due diligence phase, did you see, or did anything come up during that due diligence process?
They all go smooth, right?
Walk in the park.
Yeah, we right, exactly. No, we definitely had some hiccups. It was going really smooth for a long time, and I was thinking that, hey, we're going to have the smoothest transaction there is,
ever.
But right, exactly. And so we did have some hiccup with our financing. So we were doing a Freddie small balance deal, and we had certain assumptions that we had built into our model, and that were predicated on the feedback we received from the finance company. And the finance company, they do all, their file review, and they have 30 days to do that, and then they'll send it off to Freddie, and Freddie has to do their review. Well, we had two things. One, we had negotiated 3 15-day extensions into the deal. So it was a 60-day close, but 3 15-day extensions. And we had to put additional hard money down for each extension. I think it was like $10,000 each time we extended. But what we kind of strategized with the finance company was, look, the deal is debt constrained, and with them telling you that the first month here that you're under contract might be a little lower, we're kind of better off delaying and letting them get the next month up on income, so that we can get more loan proceeds. So part of it, we purposely delayed the process and knew we were going to have to go into those extensions. But once we got to the point where we said, okay, do your file review, it was like a week before they were going to submit to Freddie, and they tell us that our loan proceeds are going to be cut, substantially. And, I was not a happy camper at that point, because look, I've traded billions of loans, and, everything is, when you deal with large dollar transactions, setting the right expectations is critical. And so when I dealt with the finance company, I said, look, I'm having my investor meeting presentation. Give me kind of worst case scenario loans proceeds, most likely, and best case. And I'll underwrite it to worst case. Well, I did that, and then they came in substantially lower on loan proceeds from the worst case scenario.
So what was the best case scenario, and then what was the worst case scenario?
So the worst case scenario was like 71 LTV. Most likely was like 74, and best case was like 76.
Okay.
So I underwrote it to like a 71, I don't know, 71.8 or something like that. But now all of a sudden they're saying, you know, you got to come up with another 400,000. And, you know, if we're at 71, you have to come up with another 400,000. It's like a 65 LTV. It just doesn't make sense anymore. The numbers don't make sense anymore. So, you know, my partner is an experienced guy. It was great having him on board through this hiccup, because he's very calm, cool, collected. You know, nothing kind of phases him. He's got a you know, different solutions. Hey, look, you know, we could do this, or we could do this. And so within a kind of 2-week time period, we were looking at a number of different scenarios. One was, we basically told them we're not going to do that deal. So, you know, you give us your detailed underwriting, and we spent the next week or two kind of combating that. You know, some of the line items, like going back to their payroll was higher than our payroll. So we were going back to our property management company and getting some support to present back, showing that, you know, look, they're running deals at this payroll level. And in addition to that, we started talking to bridge lenders. And, you know, for different reasons, we didn't want to go down that path, but we were maybe going to be forced down that path, because so if we went down the bridge route, then one, we most likely wouldn't close in 2018. And there were a number of investors that had committed to us already because they wanted the cost segregation, depreciation allocation for year end. So we didn't know, would we lose some of those investors if we pushed to January. Secondly, you know, within our group, you know, more deals than not are long-term agency financing, and passives are comfortable with that. In addition, when I went out to my personal network, and, you know, there was a number of people that, Darin, I trust you, you know, where do you see the risk in the deal? And I explained to them, you know, from being on the loan trading side, where I saw people get hurt is when they come up on the reset and you're in a bad economic time. So if you come up on the reset and, you know, you're in a recession and financing, you know, is cut off, then, and cap rates go way up, whatever the case may be, you have no leverage. And they're basically like, hey, come to the table with a ton of new equity, or we're going to take the property. So, you know, I had pitched them on the fact that we're getting a 10-year fixed rate loan. You know, we should be able to ride it out, any hiccups. So it was a stressful 2 weeks, you know, for me, but eventually we were able to talk the lender back into coming down to our underwriting numbers. And they came back from $400,000 of additional loan cut loan proceeds to like 40 grand. So it ended up working itself out, but it was, you know, it was a little scary in the middle.
I was going to say, one of the other things that probably affected those loan proceeds is, you know, Q4 of 2018, they had 2 rate hikes on the interest rates too. So those interest rates rising, you know, cut those loan proceeds.
That could have been a factor, but we actually were fortunate that it was a Freddie small balance deal. It wasn't a Fannie deal. Mm-hmm. And we locked 3 days before rates jumped.
Wow, man, that was a good move.
Yeah. So we locked in, although rates now are lower than where we were, but it looked like a hero move at the time. So we locked in the Freddie and right before rates shot up.
What was the rate that you ended up getting on that one?
We got 4.91.
4.91. Yeah, we're seeing 3.8 now.
Yeah, right. Exactly. Like, so when it jumped up to like 5.25, 530, 540. Like it looked like we were heroes, and now it's back down to like 310. So who knows?
Yeah. Just refi it. No, just kidding. It wouldn't make sense to do that. But the deals that we're seeing now, man, it's the rates are just phenomenal. We had recently underwrote a deal at 4.8% with 5 years IO on a 10-year Freddie deal, and a little over a $16 million acquisition, and we ended up rate locking at 4.01, and it was 3 weeks before closing. And they don't usually allow you to do that until you're like the week of closing or something, and we were very excited to do that. So
yeah, 4% rate is fantastic.
Yep. So let's talk about the deal structure as well. So how did you structure this deal with investors?
So it was an 80-20 split. So 80% to the limited partners, 20% to myself and my partner Raj for the general partners. We had 44 limited partners in the deal, and our forecasted, we forecasted it on like a 5-year hold, and we forecasted average cash on cash of just north of 8% with like an 80% plus total return.
What was the IRR on it?
Low to mid teens, like 13 or 14%.
And what kind of fees were associated with this one?
Which fees are you talking about in terms of like legal and financing that type of thing, or what kind of fees?
Yeah, from the sponsorship side, as far as acquisition fee, asset management, disposition, refinance, construction, those.
So no acquisition fee, 2% asset management fee, and then the 80-20 split both on cash flow and back end capital gain.
No preferred return.
No preferred return.
Okay. And no waterfalls or anything like that. It was just a straight 80-20.
Straight split all the way through. Yep.
Okay. Awesome. And so throughout this entire process, can you think of any issues that came up outside of the financing that we've already talked about that maybe we haven't talked about yet, that kind of is something that, you were glad you went through because you were able to kind of, learn that step or that process or how to overcome it? Anything else over and above the financing side of things?
Are you referring to like at a certain point in time? I'll just talk about a few things and you tell me if I'm off. So, assumptions in underwriting, we were assuming like 300 a unit for insurance, and, a lot of the OMs were putting in like 250 a unit, for insurance per unit. And, being the first sponsorship deal, I didn't spend a ton of time on insurance. I was chasing deals and trying to get the underwriting to work and trying to win a deal. And so then when we got it under contract, then we've got to bind insurance, right? Okay, we got to get insurance prepared. And we ended up using the master policy of our property management company, but insurance came in at $375 a door instead of $300 a door. So that was like, hey, we haven't even closed yet, and I'm seeing this overage on expenses, So, thankfully the property has been performing very well since we took it over. And on the revenue side, we're beating where we thought we were going to be. So we were able to absorb that. But that's just another detail that as a sponsor, we have to be mindful of, knowing where insurance is.
That and
kind of out of our control. Yeah. The other piece is taxes, and we're in the midst of that now. We're in Tarrant County, which is very aggressive, going after, property owners. And so, we're in the middle of protesting our taxes, and we had a budget for what we thought property taxes were going to be, and we have since started to reserve at a higher percentage than we had initially allocated. Again, we're thankful that we have the revenue to kind of cover the extra expense, but we're going to have to fight that, and we're not sure how long that's going to take before we iron that out. But yeah, property taxes is huge, and for people doing their first deal, and you have brokers out there that are putting in their OM, 75 or 80% of existing, property value, you're just going to get burned if that's how you underwrite. You definitely have to build in the right property taxes.
What was the entry and the exit cap rate that were on the projections on this one?
So we bought it at like a 6 cap, and our exit cap was 7.25.
That's pretty conservative.
Yeah.
Like that. Now, did you also in the underwriting calculate in a refi or a supplemental loan after the value add play on it?
No, we did not. So that's something that we'll just look at on an annual basis. What is it time to refi? Is it time to sell? We'll just look at it. What we did do is we took the higher rate to get step down prepay. So we don't have yield maintenance on our deal. We have step down prepay. So the prepay structure is more amenable to being able to sell or refi. Mm-hmm. And it's a Freddie deal. It's a Freddie deal, so there is no supplemental opportunity. If it was a Fannie deal, then we could potentially put a supplemental on it, but Freddie doesn't offer that.
I actually was talking to a broker just this week because I heard that from somebody else, and they said that you can do that with a Freddie loan.
You might be able to do it on a Freddie large balance loan,
okay,
but Freddie small balance does not offer supplemental, and small balance, I believe, goes from 1 million to 7 million with Freddie.
Okay, so that's probably the caveat there. I have to clarify that with them and see. Is it?
It's probably a larger deal.
Yeah. Okay, that makes sense. I'm glad I asked you about that. So on this on this particular property, are you doing any type of? Not are you doing? What type of property management are you doing on it?
So we're using Winter Multifamily. They manage like 23,000 units. They have a really large presence in the DFW area. In that BC space, and a lot of people within our group use them. So they're familiar with people within our group, and vice versa. And so far, it's working out well.
And on this one, are there on-site staff?
Yeah. So there's a full-time leasing person, and there's a full-time maintenance person on staff.
Okay.
And that's built into the payroll.
Yeah, that's awesome. That's great. All right.
So it's 76 units, but one unit is actually used as a leasing office.
Okay.
And so there's 75 income generating units.
Are there any other types of amenities on the property, like pool or anything like that?
There is a pool, and it's been closed for the last like 2 or 3 years, and so we're trying to get that opened up, and so we just went through the last checklist of city items to get all the check boxes done so we can open that back up.
Mm-hmm. So
there's a pool, and there's a small little laundry facility.
Okay. So I have 2 last questions I always ask everybody.
Sure.
And they're not usually that hard, but I always like to kind of know what people are thinking here. So first is, what did you find easy during the entire process that you thought maybe in the beginning would be a little bit harder?
That's interesting, because I'm not sure that there was a ton of easy. But what I would say is, people have given me advice, and I think it's great advice, is when you're going after your first deal like this, it if you think about all the different facets to it, it can be extremely overwhelming. But if you just think about the next step, just getting to the next step, then it's manageable. And so that's kind of the focus I took was, get out there, property tours, underwrite, put in letters of intent, just get to the next step. And I didn't know how to manage an asset until we bought it, and then went out and met with the property management company, and, I've been working through it since. So, I don't think that answers your question perfectly, but that's an answer.
Sure. No, I like it. So the last question is kind of the opposite of that.
Yeah.
So, what did you find that was harder than expected during the entire process?
I'd say that the money raise, what the year I was within the group, everybody said, right now, the hardest part is finding a deal, and then don't worry about the money comes. And, what I found was when it came to money raise, there was kind of two different investors that I was talking to. One was passive investors within our multifamily group. And with those investors, they don't need to be sold on why multifamily is a good asset class and the returns and how it works and the depreciation and all the different, characteristics of this asset class. They're just like, Darin, I like you. I like your deal, but I've got 5 deals in my inbox, and I've got, 50 grand, or I've got 100 grand I could put to work. Why your deal over the others? And so what I've seen happen is within our group, and I'm hearing it from other groups as well, there are more and more deals. So passive investors have more and more choices to put their money. So that was one kind of process. The other process was talking to people that were, had never invested in multifamily, my personal network. And those were kind of one-on-one over the phone or at Starbucks, and it was more detailed. It was more educational. But then if they got comfortable with that asset class, you were the only one providing that opportunity. So I loved that part because it was, I look forward to growing that part because I feel like it's a service. Like it's a way of serving. It benefits me and my partner because we get the deal done, right? But there are so many people across this country that don't know that they can invest in these types of deals and don't know the benefits to it, and would love to take some money out of the stock market or have money in a money market fund that's not making anything, but they don't know what to do with it. So I had some people that I almost didn't call because I thought this guy will never invest, and friends of mine, and those were the ones that were so thankful that I called. So I wouldn't say that was easy, but I love the service aspect of educating new people about this asset class because I think it is a huge wealth builder.
Well, Darin, we're wrapping it up here, and I want you to share with us a little bit about how, if somebody's listening, they want to reach out to you, further the conversation, or even possibly join your investor list or whatever for some of your future possible opportunities. So, how can somebody reach out to you if they want to get a hold of you?
Absolutely, thanks, Dan. So a few different ways. One, my email address, dbatchelder@tzkproperties.com. And that would be spelled D, B as in boy, A-T, CHELDER @tzkproperties.com. Or if they want to have a phone call with me, I'm happy to get on a call. My cell number is 954-304-3236. And if they just want to kind of keep in touch with me, they can reach out via Facebook or on Instagram. I'm at Batchelder @Darin.
Well, awesome. Well, I want to thank you so much Darin for joining us today and sharing all these good little golden nuggets throughout this particular episode, and looking forward to continue to follow you as well as you closing more deals so we can have you on a future episode as well.
Absolutely. Hey, Dan, I really appreciate you having me on, and hopefully I'll be able to catch up with you when you're in Dallas.
Yep. Sounds great. Looking forward to it, Darin. Talk to you later.